What's up everyone? Welcome to Investing for Profits. My name's Nate. Today we're going to be talking about price to earnings ratios, or PE ratio. We've learnt a little bit about earnings, share price, shares over the last couple of episodes. Now we start tying it all together. So this is where we start to pull all those things together to look at a ratio known as the PE ratio that is probably the most well-known ratio and the most widely used ratio for investing analysis. As part of this, we'll cover off what a PE ratio is, how to calculate it, some examples, as well as look at one or two companies so that you can go away with a really good understanding of what the PE ratio is and how you can go about implementing that within your own strategy. So without wasting any further time, let's get into it. So let's start off by getting really clear on what the actual definition of a PE ratio is. A price to earnings ratio, or PE ratio, is a ratio that seeks to measure a company's share price relative to its earnings. If earnings is something that you need to understand more about and you haven't seen our last video, click the link above and I'll also leave it down below in the description so you can go and have a look at that as well and get a better understanding of earnings per share. So with that being said, how do we calculate the PE ratio? The PE ratio is the share price divided by earnings per share. For those that watch some of our earlier videos, it can also be calculated as market capitalization divided by total net earnings. We're measuring the same thing. One is at an organization or company level, the other is at a per share level. So why do we use the PE ratio? We use it so that we can compare companies with other companies. It helps eliminate variables of what their different earnings are or different share prices to compare them with something that is like for like. It also allows us to compare across multiple sectors. I'm going to use a left field example of explaining the PE ratio. It is a very powerful example, but it also helps to break down what the PE ratio is and make it easier to digest and easier to understand. So with that, let me tell you about my magic money machine. This magic money machine generates $1,000 every year without fail out of thin air. And I'm going to sell this money machine to you. So the question I have for you, how much are you going to pay me for this magic money machine that generates $1,000 every single year out of thin air? Would it be $1,000? $1,000 would mean that at the end of 1 year, the magic money machine has generated $1,000. You've got your $1,000 back, plus you still own the magic money machine that is going to continue generating $1,000 every year thereafter. That's a pretty good deal, but it's not a deal that I'm likely to take. It's not necessarily a great deal for me because if I hold on to the magic money machine for another 1 year, I've got the $1,000 anyway. By the way, if we just go back to our PE calculation example, we had a share price divided by earnings equals PE ratio. If you're going to buy my magic money machine for $1,000 and its earnings are $1,000, that is a PE ratio of 1. So what about $100,000? Would you buy my magic money machine that generates $1,000 every year without fail out of thin air for $100,000? What a deal for me. It's going to take 100 years, ignoring inflation and all of those other things, but 100 years for you to generate $1,000 every year, meaning that you get your $100,000 back. Is that a deal you're going to want to take? I wouldn't have thought so. I wouldn't have thought you're interested in paying a sum of money today that's going to take 100 years just to get that initial capital back. And what would that be as a PE ratio? We've got a share price or a magic money machine of $100,000 divided by earnings of $1,000 is a PE ratio of 100. So let me ask you again, what would you pay for my magic money machine? Actually, leave a comment down below. I'd love to hear different ratios that people are thinking for a really simple example like this. If you're struggling with the thought process of this and struggling to grasp the concept, flip it around slightly and let me ask you a different question. If you owned the magic money machine that generates $1,000 every year out of thin air, how much would I have to pay you in order for you to transfer ownership of that magic money machine to me? So how much would you pay for this magic money machine? I don't know, it's a hypothetical example, but without overthinking it, let's say we'll pay $10,000. So the PE ratio for that, 10,000 as a share price or the price of the magic money machine, divided by the earnings of $1,000, gives us a PE ratio of 10. The price to earnings ratio, or PE ratio, really isn't any more complex than this. Sure, the numbers change, we're not using round numbers, they might go up and down and every company's different, but the concept of a high and low PE ratio, undervalued, overvalued, what we went through just now is exactly what it is. So if you're struggling with it when you start looking at companies, come back to that simple example and think about, what is the PE ratio actually trying to tell me? What do I take out of that PE ratio? So to help move this example forward, let's look at another example, because I actually didn't tell you, but I have two more magic money machines. Now they are slightly different and I'll explain the differences, but what is important is that each one of these magic money machines all generated $1,000 last year. So the first of the two additional magic money machines I'll tell you about now. So as I mentioned, it generated $1,000 last year. However, it doesn't generate $1,000 every year. It's always between $500 and $1,500. So on average, it will generate $1,000. It is an older machine and at some point it's going to stop working. I'm not sure when that is. However, what I do know is that it's not showing any signs of stopping yet. So that being said, how much would you pay me for this second magic money machine that varies with how much that it'll generate each year? However, on average is about $1,000, but at some point it's going to stop working. What price would you pay? I'd imagine you're thinking somewhere less than the PE ratio of 10 that we spoke about before, being $10,000. I don't know what it would be, but you'd be thinking, yes, I'm going to get $1,000 every year, up or down, 500 one year, 1,500 the next, it'll average out as 1,000, but it could stop at any point in time. So with it stopping at any point in time and that additional risk, chances are is waiting 10 years to recover the cost of your capital investment, you're likely not wanting to wait that long. So it might be somewhere around $5,000. 5,000 divided by $1,000 worth of earnings is a PE ratio of 5. So my third money machine, this magic money machine is the newest, it's the latest and greatest. This is the Rolls Royce of magic money machines. This magic money machine also made $1,000 last year. However, the year before, it made $500. The year before that, it made $250. And the year before that, it made $125. What's it doing? Every year, the money that this magic money machine generates is double what it did in the previous year. What does that mean for next year? It will generate $2,000. The year after that, $4,000, $8,000, $16,000, $32,000. How much are you paying me for the Rolls Royce of magic money machines being my third magic money machine? So what are you going to pay for it? I have no idea, but let's call it $30,000. $30,000 means you recover your capital investment within 4 years, being $2,000 next year, then it goes to 4, which puts you at 6, then it goes to 8, which takes you to 14,000, and then it doubles to 16,000, which takes you to 30,000. What's the PE ratio? $30,000 for the magic money machine divided by $1,000 earnings that we have today is a PE ratio of 30. Now, just thinking about these three magic money machines, especially the third one, why are you willing to pay a PE ratio 30 times what it's earning today? You're willing to pay that on the basis that you're expecting those earnings to increase in years to come. So you're willing to pay more today for the benefit of what you'll get tomorrow. This is a classic example of a growth company. When you have a look at growth companies, you will see PE ratios that will be 30, 50, 70, 100, 300. They'll be really, really high. And they're really, really high because people are willing to pay the money today with the view that there's going to be a brighter future tomorrow. Doesn't always mean it's going to be the case, but people are banking on the fact that that company is going to grow, and that earnings, as an example, it's $1,000 today, in 4 years' time, might be $16,000. And if it is $16,000 and it has a PE ratio at that point in time of just 10, what does that mean our share price or our magic money machine is going to be worth? $16,000 worth of earnings multiplied by 10 is $160,000. That's why I'll pay $30,000 today, even though it's $1,000 worth of earnings, because that I know in the future, if my prediction's right, it's going to be worth a lot more than that. The point here that I'm really trying to make is that all three magic money machines are great magic money machines if purchased at the right price. Any one of those three magic money machines could make you a lot of money, or could certainly make you a really healthy investment if you can purchase them at the right price. Even the second magic money machine that I spoke about that is going to break or stop working at some point in the future, if you were able to purchase that for $1,000 at a PE ratio of 1, if you get 2 or 3 years out of that magic money machine, you've made a return on your investment. In the example of the third magic money machine, if it was priced at $1 billion, it's going to take a very long time for you to recover your investment up front. So it doesn't mean it's a good investment. Imagine if you could buy that third money machine at $10,000. You'll make your money back very, very quickly, and that will turn into an amazing investment. So the point is this: the PE ratio is just a guide as to whether a company is overvalued or undervalued. You want to be buying a company when a PE ratio is at a level that you think there is great value for that company and that you're really comfortable with the fundamentals of that company carrying into the future. So let's have a look at 2 real examples. Now, I just want to be really clear with a disclaimer up front that looking at these 2 examples, at no point am I making a recommendation that this is a company you should be buying or a company that you should be selling if you own the company already. We're looking at these 2 examples purely as an educational purpose to help try and embed some of what we've learnt today and to help you with being able to go away and do this with companies and feel more comfortable in building the PE ratio into a critical part of your investment strategy. So with that, let's jump in and have a look at our first company, Exelon. You'll find this as EXC on the NASDAQ. Exelon is an energy company based out of Chicago, Illinois and Pennsylvania in the US. It generated $33 billion of revenue last year. So it's a big company. When we have a look at the earnings per share or EPS over the last 10 years, we can see that in any one year, we had a low result of $1.21 and a high result of $3.98. And we had $2.01 in the most recent year. When we move over and have a look at the price to earnings ratio or PE ratio, we have a low of 10 and a high of 29, which is a big range that we're working within. The most recent result was 21 and the median average is 17. If you're not sure what a median average is, I'm sure you can find it online, but really quickly, you take all of the numbers that you're looking at, you line them up from lowest to highest, and you take the very middle point or the very middle number. So if we now take our most recent earnings, which was $2.01, let's call it $2, and we apply our low, median, and high PE ratios, we will get a range of a share price from 20, which is $2 earnings multiplied by 10 PE, and then a high range for the share price of 58, which is the 29 PE multiplied by the $2 earnings. So that's the price that the share price would fall based on the last earnings report and the low and the high of the PE. From a median PE, we said it was 17. So $2 for the earnings times $17 for the median PE gives us a share price that we would expect of $34. We can see that the current share price is $43.79, and that's getting towards the top end of our range. Let's have a look at one more example. We'll look at Garmin. Garmin is known for its GPS technology. And if you're a runner like I am, I'm sure you've got a Garmin watch or you've seen a Garmin watch before. Garmin is a company that has generated $4 billion plus in revenue. So let's have a look at the earnings per share or EPS first. As we can see, the EPS has sat between $2 and $3 for the most part. Recently, it's grown to $5.17. If we think $5 is a reasonable assumption for Garmin now and into the future, we'll use that for the purpose of today's modelling. When looking at the PE ratios over the last 10 years, we can see that we've had a low of $14.69 and a high of $27.82. We can also work out that there's a median average of approximately 16.5. So let's take our earnings of $5, multiply that by our PE ratio expectation of 16.5, and we get a share price of $82.50. And then when we go and apply our low and high range for our PE ratio of 14.69 as our low range and 27.82 as our high range, we would get a share price against a $5 earnings of $73.45 and a high share price of $139.10. Now we can see in this example that Garmin is trading at $125.10, which remains in the top end of our range. Well, there you go. You're now an expert in the price to earnings ratio or PE ratio. Like anything, these things take practice. So take it away, apply it to companies that you're looking at, apply it to companies that you've got, and go through the same exercises we did today. I'm sure it'll be second nature before you know it. If you've learnt something from today's video, please give us a like. I'd also love to hear some examples of how you've used the PE ratio for successful investment choices, or ones that haven't gone so well. Also, if this content is helpful for you and you are getting something out of it, please click the subscribe button. It really helps me to make sure that I can continue to generate content that is useful for you and for others. Happy investing.